Hello everyone.
Recording in progress.
Hello everyone. Nice to meet you all and welcome back to my channel. Right now I will explain you about the financial working, but first of all let me introduce myself. My name is Wahyudi Akbar Sugya with NPM 214111090. I'm from Technocrat Indonesia University, specifically Faculty of Economic and Business. Okay, this topic is financial working. What is the financial working? Okay, we have to know financial working capital refers to the amount of funds used by a company to run its day-to-day operations. It includes all sorts of funds used to support the company's operational activities such as purchasing inventory, paying employee salaries, and financial receivable. There are two types of financial working capital. The first one we have net working capital. This measures the difference between current assets that can be turned into the money quickly, such as cash, amount receivable, and inventory, and current liabilities, a debt due in the near future. A positive net working capital indicates that the company has enough current assets to pay current liabilities, while a negative net working capital indicates current liabilities that exceed current assets. The formula is net current capital equal current asset minus current liabilities. The second one we have working capital cycle. This measures how long it takes for a company to convert investment in inventory to cash through the sale of products or service. A short, a short, short, a short working capital cycle in this desirable, as it means that the company can manage funds more efficiently. The formula is working capital cycle equal inventory period plus receivable period minus payable period. Financial working capital management is very important as it can affect the liquidity and financial health of the company. If working capital is not managed properly, the company may experience liquidity problems, difficulty paying debts, and lost business opportunities. Companies usually strive to maintain positive working capital and a short working capital cycle to ensure smooth continuity of operations. This can be achieved through good inventory management, receivable management, and efficient cash management. And the next one we have capital type. Here are a brief explanation of each type of capital or element. The first one, cash. This includes cash held by the company or available in the bank account. Cash is essential for meeting obligations or they come due the day-to-day operations. Receivable. This includes money that the company must receive from customers or third parties for the sale of goods or service. Receivable are assets that are expected to be received in the short term. The third one we have inventory. Inventories refer to goods or raw materials held by the company for the future production or sale. It is an asset related to business operations. The fourth one we have short-term investment. Short-term investment are financial investment held by a company and are expected to be sold within a short period of time, usually less than 1 year. Example of short-term investment include securities and short-term deposit. The fifth is account payable. Accounts payable are obligation owed by a company to third parties such as suppliers or creditors as a result of purchasing good or service. These are obligations arising from business operations. Number 6, we have accrued expenses. There are obligations owed by the company for certain costs that we meant to be repaid in the future, such as unpaid salaries, accrued taxes, and other bills. All the debts are important elements in a company's financial analysis and are used to calculate financial ratio, such as liquidity ratio, debt ratio, and profit ratio. This assists relevant parties in assessing the financial health and performing of the company. The next one, we have gross working capital. What is the gross capital? The gross working capital calculation is one of the methods used to measure a company's ability to manage its financial research. Gross working capital measures the difference between a company's current assets and current liabilities. The formula is gross working capital equal current assets minus current liabilities. To calculate gross working capital, you need to gather information about the company's assets and current liabilities. Current assets usually include cash, account receivable, inventory, and other short-term investment, while current liabilities include account payables, short-term bank loans, and other liabilities that must be repaid immediately. Example for this gross working capital calculate. The first one, we have assume ABC company has $500,000 worth of current assets. The second one, we have ABC company's current liabilities are $300,000. Then the gross working capital calculation is follow. Gross working capital equal $500,000 minus $300,000 is $200,000. So the gross working capital of company ABC is $200,000. This means the company has $200,000 in current assets that can be used to meet its current liabilities. A positive gross working capital indicates the company's abilities to meet its current obligations, while a negative gross working capital indicates a potential liquidity problem. The next one, we have what is function of working capital. The first one, working capital is the fund that a company uses to run its day-to-day operations. The function of working capital business is very important and includes several key aspects, including is the first one, maintaining company liquidity. Working capital helps a company maintain its liquidity. Liquidity refers to a company's ability to meet its financial obligations, such as paying debts and employee salaries without difficulty. With sufficient working capital, companies can ensure that they have enough cash and assets that can be quickly converted into cash to meet those obligations. The second one, we have risk reduction. Sufficient working capital also help reduce the risk of bankruptcy or financial distress. If companies do not have sufficient working capital, they may be forced to take out loans or sell assets to meet obligations or they come due. This can increase the company's financial risk and even lead to more difficult financial problems. The third one is accelerate collection of receivables. One of the components of working capital is receivable, which is money that must be received from customer or clients. With a sufficient working capital, companies can more easily monitor and accelerate this collection of receivable, reduce the risk of bad debt, and optimize cash flow. In addition, working capital also has other functions such as ensuring sufficient stock to run operations, paying creditors on time, and supporting business growth. A good understanding of working capital and its management is essential in running a healthy and sustainable business. This is all from me. If you have any question, let me know it in the column commenter. So nice to meet you in the next video. See you next time. Have a nice day. Thank you.
Recording.